concept is historical cost. This principle dictates that asset and liability should be recorded at their original purchase price. It provides a reliable and objective basis for valuing items in the financial statement.
Moving on to prudence, this concept encourages accountants to exercise caution when making a final decision, preferring understating rather than overstating profit and asset. It helps in avoiding over-optimistic assumption and ensure a conservative approach to financial reporting.
Today I will explain to you guys about basic accounting concept. There is consistency and matching. First is consistency. Consistency is concept of accounting state that a company should use the same accounting policies and method for recording the transaction from one financial period to another. Next is matching. Matching is the accounting concept that the expenses are incurred during a period be recorded in the same period in which the related revenue are earned. This concept recognizes that businesses must incur expenses to earn revenue.
Our fifth concept is accrual. Accrual accounting record revenues and expenses when they earn or incur regardless of when cash is received or paid. It provides a more accurate depiction of a company's financial performance by recognizing economic events as they occur. Moving forward, we have materiality. This principle states that financial information should only include items that will influence the decision of users. It allows accountants to focus on significant transactions and events, ensuring that only relevant information is present in the financial statement.
Let's discuss the going concern concept. This principle assumes that the entity will continue to operate indefinitely unless there is evidence to the contrary is provide a basis for valuing asset and liability. On the assumption of continued operation. Objectivity. Now let's explore objectivity. This concept requires financial information to be based on reliable evidence rather than personal bias. It ensures that the financial statement reflect to the economic substance of transaction and event.
Hello, my name is Nur Adila Natasha binti Muhammad Yusri. I am holding a matrix number 01DIF23F2014. So I'll be talking about 11 basic accounting concepts. Our ninth concept is money measurement. The money measurement concept means that only those activities or transactions that can be expressed in terms of money are included in the accounting records of a business. This principle ensures that the financial statements are expressed in a single and consistent unit of measure. There are a few of key aspects of the money measurement concept. Number one is monetary quantification. It is said that only those facts and transactions that can be expressed in terms of money are recorded. For example, sales revenue, purchase costs, salaries, and more are recorded because they can be quantified in monetary units. So moving on to the second one is currency utilization. The financial records are maintained in a single stable currency, typically the national currency of the country where the financial statements are being prepared. This standardization helps in comparing financial statements consistently over time and across entities. So the third is objective and verifiable. The concept supports objectivity and verifiability in accounting by insisting that only measurable data be used. This helps reduce bias and provides a clear numeric basis for financial reporting. So moving on to the next point, which is business entity. The business entity concept is a fundamental accounting principle that treats a business as a separate entity from its owners or any other business. This concept, also known as the economic entity assumption, ensures that the business financial transactions are recorded and reported independently of the personal financial affairs of its owner or any other business entities associated with its owners. Here are some key aspects and implications of this concept. The first one is separation of finances. The business financial information is kept completely separate from the personal finances of the business owner or any other entities. This separation is crucial for clarity in financial reporting and analysis.
Let's discuss periodicity. This concept divides the economic life of a business into artificial time periods such as monthly, quarterly, and annually for financial reporting purpose. It facilitates the systematic recording and reporting of financial information.
I will explain to you guys about two source documents in businesses. First is receipt and invoice. First source document is receipt. This simple document serves as proof of payment for goods or service received. Whether it's a paper slip or electronic confirmation, a receipt is essential for both customer and businesses to track transactions. Next is source document. Is invoice. This document is issued by a seller to a buyer requesting payment for product or service provided. Invoice outline the detail of transaction, including item list, quantities, and price, ensuring clarity in financial dealing.
On to the purchase order. This document is initiated by a buyer to request good or service from a supplier. It specifies the type, quantity, and agreed price, serving as a formal request for the purchase of good or service. Let's talk about bank statement. A bank statement is a record of all financial transactions occurring over a specific period for a bank account. It provides a comprehensive summary of deposit, withdraw, and other activities, essential for financial reconciliation and monitoring. That's all for me. Thank you.
I'm going to explain about payroll records. Payroll records are essential documents that detail information about employees' compensation and related transactions. So, payroll records include details about each employee such as their full name, address, social security number, date of birth, employment status like full-time or part-time, and any relevant tax withholding information. The second one is payroll records also contain about earning. This section outlines the various types of earnings an employee receives, including regular wages or salary, overtime pay, bonuses, commissions, and any other forms of compensation. It details the rate of pay and the number of hours worked for each pay period.
Next, we have shipping documents such as bills of lading or packing slip. These accompany goods being transported and provide essential details about the shipments, including contents, quantities, and destination, facilitating efficient logistics and tracking.
Lastly, let's discuss credit memos. This document indicates a reduction in the amount owed by a buyer to a seller due to returned goods overpayment or other reason. Credit memos help adjust balance and maintain accurate accounting records.